Hey guys, welcome to another video. And in this video, I'm going to go through the breakdown of what we need to do in this US session. Where the dollar index is going, should we go long, should we go short, what are we doing? I'm going to explain it all in this video. So let's get started. Okay guys, so from the previous post that I put out about the dollar index, I told you on Friday that the move has begun. And of course, that takes a lot of bravery to say that because, of course, there's always a percentage that I possibly could be wrong, right? Now, I'm going to go through the reason why. Again, we're looking at this and what this means for us. Now, I've left the final analysis here. But I'm going to start from the beginning and break it down as to how I arrived here so that you can get the thought process behind what we're looking for and also what pairs I'll be trading based on this price action here. So let's begin. Now, what I'm going to do, I'm going to bring up the dollar index again, and let's start from the beginning. So if I start from here, standard chart, start from the monthly. So as a recap of the analysis now, I'm not going to go through the monthly time frame analysis. I'm just going to draw this out here and then skip straight down to the D1. Now, if you want the full analysis, please watch the previous video that I've made. It's episode 4 of the game plan video. Now, if you've never watched a game plan or ever heard of it, this is your first time listening to my videos. The game plan is, as it says, the game plan of what we look for. I give out my highest probability trades, what I'm looking at, potential entries and etc. to give you a game plan for the week. Now, I usually do it on Friday so that coming into the next week, you have something in the back of your mind that you can work with beginning the week. Now, the game plan was inspired by the fact that in my previous time of trading years ago, and it's been many years ago now, I didn't have a game plan when I was trading. I had analysis skills, but I didn't have a game plan of what I was looking at. And one of the things I did is that because I really wanted to get into the market, as soon as Monday hit, I started to create a game plan as the price starts to move. Instead of looking at market structure and kind of making extrapolations as to where the price is going to go and what I'm going to do with it, or what I'm going to do if price reaches certain areas. So as a result, I kept on getting many losses because I didn't have a game plan. I didn't have a strategy of how to go in, but it doesn't mean I didn't have a trading strategy. And there's a difference between having a strategy or a game plan for your overall trading career compared to a trading strategy. Because your strategy, of course, you need price to actually do certain things before you can actually make an entry. But with a game plan, this is more of being as a trading career where you're setting yourself up to put yourself in positions, even from the time you wake up, what time you're going to wake up or what time you're going to look at the charts. All of those things matter when you're making what I call a game plan. So I've delivered everything that you guys need in order to work out exactly how to get a perfect entry and take full advantage of what's to come in the market. So I'm going to go straight to the D1. Now, on the D1 time frame, the beginning of the trigger started when the price took this low right here. Okay. At the beginning, at this movement here, which happened on a Friday, which doesn't surprise me, we had a strong piece of price action happen here. Now, the price took the low of the month of February, and also on that same day, I'll just put this beneath here. Now, I think what I'll do, I'll get rid of this D1 line just to give some space. So I'll put it over here like this so that it's not in the way, but we know what that line means. Just drag it across here, something like that. And I'll just leave it here like this. All right, so we've had an induction here, and this induction is a key one. And I will spend a little time to explain why this induction is so important. Now, with the dollar index, this movement that we've had triggered a very strong long. The trigger for it happened from news. And as I've been saying in my teachings, that I'm not a fundamental news trader in terms of looking at FX Street, Daily FX, Forex Factory. I don't use those pieces of news to trade or scalp them or stuff like that. I used to, but I use those pieces of news to work out when most likely triggers are going to happen for analysis that I'm already waiting for. The price is the best indicator that you can have. Hence why you see me with no indicators with trading. Now, it doesn't mean if you trade with indicators, you're bad or you're naughty. As I was growing up in the trading industry, there was a time where people that traded with indicators were seen as, the retail lesser traders, and the guys that just plain chart trading, they were the experts. And it's not exactly like that, I would say. indicators do have some benefits. As a developer myself of indicators, there are indicators that can be useful to aid your experience, you know, but I guess the word indication might not help sometimes because, you know, sometimes your indicator, or always, to be fair, your indicator will always be lagging behind the actual price because, you know, not to be geeky, but the computer has to make many processes or has to process the information that comes from the code of your indicator, and that small delay could cause you to have a delay in your price speed. Another thing is if your indicator is mathematically slightly inaccurate from what the price is actually saying, you could be off as well. So that's the reason why I personally don't use indicators, but I would use helpful tools that in MetaTrader would be in the indicators folder. So things like, you know, letting me know when news is going to happen or things of that nature. Anyway, now that you understand that, let's go back to where we are. So this induction that we had here, why is this one so specifically important? Well, first, let's look at the broad scheme of things. One of the most important things that's happened here is that we have a clean break of market structure. We have multiple. Now, we had one on Friday over here where the body of the candle closed above this swing high, which is a market structure break, okay? And I'm going to put this here for short. We have a market structure break, okay? Now, specifically, we have a break of bearish market structure. So I could put break of market structure. I'm just trying to find a good color to put this on. I'll just use the dark violet. Okay, so we have a market structure break over here. We have one here. Now, this market structure break is good. Okay, the price has broken market structure clearly, but the better one, which has just happened, you know, at the end of Friday and confirmed today, this very Monday, is this one here, because this is the high of the previous day. So now that we have a strong close above the high of the previous day, that's a much stronger indicator that we've broken bearish market structure. So I'm going to take this off. I think this purple is not that great visible-wise, so I'm going to change this to black. Or in fact, let's just use blue because I think that will shine a bit better. Here we go. Yep. So we have a break of market structure, specifically of bearish market structure. Now, what do I mean by that? Well, foundationally, market harmonics, which is something that every trader should learn and should know. Now, these days, looking at traders, I see that a lot of them do not write out their A's, B's, and C's, maybe because you know them already. But the beginning of this swing starting from Thursday would be an A swing here, and the bottom here is B, okay? Now, what the A to B movement of any market harmonics, whether it's bullish or bearish, now to explain market harmonics for those you've never heard, the harmonics or the way that price moves, okay, is in a harmonical structure that we call a trend, okay? And for bullish price action, or when the price is increasing in value, this is the general trending structure we have. We have a first movement here, okay, which will be our bullish movement, and then we have the retracement, okay? So we have the burst of liquidity that pushes the price further up, and then we have the retracement, okay? And this causes us to have our A, B, C, D swing, okay? This is the structure. Now, on the opposite side, when the price is decreasing or selling off, or what we'll say is bearish, we have this structure here. Okay, so I want to draw these so that you have a bit of context before I continue. Okay, so the opposite side of the story now, these points here, A, B, C, and D, represent the swing points or the shifts where price shifts from one momentum to another. So from a bullish momentum to a bearish momentum, or from the price increasing in value to decreasing. So these points here become significant areas to mark out the direction of trend and which direction liquidity is flowing to. So another way to say this is when the price is bullish, okay, on the market order book, the number of buy orders and the liquidity value of buy orders is greater than the selling orders, which is pushing the price up. That makes more demand. And vice versa, if the price is going downwards, we have a lot more sell orders in liquidity amount, not necessarily amount of orders, because amount doesn't equal to liquidity, because you could have a strong amount or a high amount of orders, but their value is low. Like for those of you who know pips, you could have 1,000 orders at 0.01. If you times that by, 1,000 times 0.01 will give you 10 lots. But then you could have only 5 orders on the other side of the market, which are 100 lots each, which is 500 lots. Therefore, the amount of trades or the volume is not as important as the liquidity. Okay. And in terms of market participants, there's a lot more retail traders in the market than there are institutional and governmental. Okay. But nonetheless, they move the market completely. Mathematically speaking, retail traders don't have enough liquidity to move the market by even a small margin. Okay. So putting that into perspective, it helps you to understand why market harmonics is what it is as market harmonics. All right. So from this initial move A, B, and C, and I'm ignoring the news for a reason, when the price got above here, okay, and formed this new swing here, the body of the candle where this swing is closed above the A point. Now, when the body closes and not the wick, what that means is that we have a break in the structure of this trend. So instead of price continuing to go short here, what we have instead, it looks like this. So if I pull this up here, and was to do it again, instead of the price stopping lower, which is where we get the term lower highs and lower lows, or higher lows or lower lows, depending on the direction you're in. We've had the same situation. We've had A, we've had B, but when the C point was supposed to be a high, but lower than A, it's become higher than A, okay? So that means that the structure has broken. Now, when the structure breaks in this manner, then we do what I call, and I tell my students, which is musical chairs, which means that the lowest point here, over here, becomes A, and the major break where the price broke at the previous swing here becomes the B point. And this is the foundation of what a break in market structure means. Now, there are levels to what the meaning is with this structure break, but in essence, what it means is that money in the market, or supply liquidity or demand liquidity, in this case, demand liquidity has exceeded supply liquidity, and as a result, there's a shift in the direction of the market as a result, or an incoming shift. Okay. Now, to confirm the new trend, the price is going to have to pull back down to the C point. And then what we get finally is a return here. And then the price will continue and move upwards. So this is the kind of the foundational structure break and market harmonics price action that we see in the market and how price operates. Now, the reason why the price moves from A to B and then B to C are many, but the foundation reason I can give, and I'll make a video where I go through the different reasons, is that when we have an injection of liquidity in that has a certain amount of value, at this point, there will be sell-offs, and that sell-off will cause the price to pull back. On a deeper level, injections of liquidity are designed to cause people to get into the market at the wrong time, or too early for a buy or for a sell, and pull the price back. So I'm going to demonstrate here before I continue the analysis so that you can understand where we are. Now, the key thing is here, this area that I ignored, which is the induction, and a very key reason why I said that the time is now for the movement. I'm just going to use another color to put this here. So this area right here, maybe I should get this a bit lighter. I'll make this blue. Okay. So looking at the price action here, why is this area important? Well, now that we know that the market structure is broken, the lowest swing low is over here at A, and the highest swing at the moment is actually not C, because into today we've had a higher swing high form. So that's the B. Now, another important thing to notice is that when the market makes a new trend, the first major swing from A to B is what we call the parent swing. And that's the determinant of what direction we're in. Now, when A is lower than B in price, because these are still prices. So in this case, the A price is at 100.323 and B is at 101. Let's just call it 101.429. Because A's price is lower than B, which means the price is going upwards, this becomes the parent swing. And this parent swing is the determinant of market structure. Okay. Now, usually, and this is how it should be with market harmonics, in terms of the bodies of the candles and not necessarily the wick, the A to B movement and the C to D movement should be longer than the retracement. So the thrust movement, as it's called, the thrust movements are always greater than the retracement. Why? Because if demand is greater than supply, when the price is here, so I'll just draw this out for you over here. This is demand over here. So at this point, demand is greater than supply. All right. And the demand greater than supply, before I draw it here, this is the key. When the price is going upwards, it means in general, demand liquidity is stronger than supply. All right. And individually between trends, demand, and I'm going to represent demand as D to save time. So demand is greater than supply here, and to save space also. Then when we have this retracement from B to C, supply for a moment is greater than demand. And the simplest foundational reason, there are deeper reasons for it, is that we're having a sell of price, there's profit being taken, prices pulling back here to the next area of demand so that the price can continue. The price will be pulling back to look for the next area of demand to drive the next level of movement. Okay. And then we have the next movement where, again, demand is greater than supply. Okay. But foundationally, demand is always greater than supply when the price is in a bullish direction. So when this happens and we have this structural movement, what we're going to need would be a pullback. So in the case of the dollar index, we're going to need some sort of pullback over here. And then we're going to need, from that point, our push here. Now, for these movements to happen, there needs to be some sort of induction. What does an induction mean? It means a manipulation of traders, or an induction to cause traders to go in the opposite direction. In this case, this induction here, which was created by this spike here, created by the news, is our induction. All right, so I'm going to write this here, induction. Now, what does this induction do? What is it designed to do? Well, whilst I write this in, so this is our induction, all right? And this specifically, I'm going to leave it like it is now, and then I'll add some more notes to it. Now, if you look at the price, I'm going to just start from the H1. I'm not going to go any further than here. But if we start from the 24th till now, the general trend is bearish. Even if I was to draw a trend line across here and kind of cut it through the candles, you can see that the general trend line is bearish. So the bias for human beings, and more importantly, also for trading robots, would be to look for sells. Now, the dollar index is not really something that, the average trader trades. Some people do, some people don't, but most people don't prefer to trade Forex and commodities and stuff, or crypto. But the dollar index is worth $4 quadrillion because not just the dollar, there's other currencies, major world currencies, weighted together with the dollar index. So the dollar index has a lot of liquidity flowing through it. Okay, 4 quadrillion approximately. Okay, dollars. So because there's that much money in this market, every movement here would mean a lot of different consequences in terms of when the price spikes and upwards or downwards. So in this induction, what was this designed to do? Now, if we just look at this previous week gone, okay, so this is the end of the week before that. This is the beginning, the week starting the 10th. We had this bullish movement. And then for the rest of the week, the price was bearish. So for an intraday bias for a trader, most likely be looking for the sell. Now, just before the price did this movement, we can see over here that we had some swings form. So if I was to steal all of this movement here, so I'm going to steal some A's and B's over here. I'll put them in a color that stands out so that you can follow me along. So I'm going to steal an A over here. Now, on Thursday, now specifically over here, the 13th is Thursday last week. On Thursday, the price gave us a massive strong drop, okay? And even into Friday in the morning time, the body of this candle closed beneath this area here. Now, another basic of price action is that if the body of the candle closes specifically, for example, beneath a previous low, the expectation generally is there for there to be a continuation. And then you're going to see how the market behaves by the time I'm done. So when we look at this movement, okay, and what I'm going to do is draw the next swing, which will be B. Now, based on market harmonics, which is why I would say market harmonics alone is a foundation, is not the be-all and end-all. And in my early days of trading, I learned the hard way that market harmonics is not the only thing that you look at to determine a trade. But just looking at basic market harmonics, even for robots too, who will be following the trend of the price, no matter what strategy they have, you can see we have an A swing form here. So this A swing, maybe I'll make this larger. Let's make this 10. And let's make it blue. different type of blue. I'll go for medium blue. So here is A. Here is the B swing over here at 10. And then over here would be C. Now, if you notice with the C swing, before I go over to what the induction has done and did do, let's get this right. You'll see that this C swing happened. Okay, I don't know, I've got capital. I probably did that by accident. There you go, smaller. This swing here at C happened just before the induction. Now, inductions are triggered by algorithms, and they're a key manipulative factor that causes price to do what it does, where we have these massive movements. So if we look at the anatomy of this price action here, we have A, we have B, and then we have C. Okay, the expectation when the price pulled back here just before this wick happened is that we should be looking for a sell-off, because the prices, if I zoom in just a little bit here, it might cause things to shake up a bit, but it's all right. Here is A, here is B, and here is C. Okay, you can see that the A swing, the body of the candle hasn't closed above A at this candle. So this is still a valid bearish trend. And the expectation should have been something like this, where the price pushed down short and we have another sell-off. Okay. And if you look at the buyers for the last 2 weeks, for the week that price action was in, which was the week starting the 10th, should be thinking, yeah, we should be going for a short. Okay. And so many, and here, listen to this carefully, when we get to this range around C, there should have been many sell orders over here. All right. Now, for the market to change direction, for institutional money to make money from us, okay, they need to get as many people in the opposite direction, which we call an aggregate. So they need to get, in this case, for them to push a buy into the market, they need to induce as many people into a sell position. And this can be through pending orders or through actual market orders at the same time. Okay. So what would have most likely happened, and the reason why this induction will happen with the news specifically, is because the news is a very fast reaction. So it's quick enough to stop people out of their positions and go the other way without being detected as easily as possible. If this happens slowly, then of course traders will come out of their movement if they notice the price going long. Of course, anybody would. But this movement here happens so quickly that it wouldn't give you enough time to think about it, and you're going to take that L, as we would say, or take the loss. So this induction here, okay, designed in this case to trigger and stop out sell stops, plus also sell orders, okay, market orders, market sell. I'll put market sells for short because that will make more sense. Market sells. Okay, so this is the reason why this induction happened. Now the induction happened at 1:30, which was the retail sales news. Okay, and if I took this to the M15 before I go through where we're looking at in terms of price action, so I'll pull this here. So if I go down to the M15, you'll see this a little bit more clearly. So if I put this here very quickly, so here's A. Now I need to make this large. I'll just make this 12. All right, so here's A. Here's the B right here. And if you see this more clearly now, you see that in market manipulation is not that straightforward and just very obvious as sometimes people may make it seem. The market is very crafty because it has advanced machine learning. Every single time the market moves around, the algorithms of the market, what we call black box algorithms, are learning from traders' price action movements. You know, they're learning from how traders trade. Okay, and those algorithms are becoming better and better. All right, so you can see A, B. Notice that if I go to the M15, you can see the anatomy of price a lot better here. What's actually happened is that the price has pushed short and started to look as though it's pushing short. And then the news is here. This is where the news is. So I'm going to mark this off at the news. If we want to be more specific, I'll go down to the 1 minute here, and let's be more specific here. I'm going to scroll up. This is the news candle. This is the first time the news comes out. This first minute is right here. All right, so let's make this another color. Let's go down to purple. All right, so this is the purple. This purple area here is the 1 minute candle. So that's 1:30 on the dot. If I hover over the price just to prove what I'm saying, you'll see over here that it says 3:30. The market time compared to my time in the UK is 2 hours ahead. So it says 3:30, so it's 1:30 for us. So notice the price wicks down very quickly and then pushes strongly long immediately after and then continues to go. So within about 15 minutes here, the price has already done 53 pips away from the sell direction. So at that point, most traders would have been stopped out by then. Okay, and in panic, probably maybe some traders may have even tried to put another sell at the top here, thinking the price has come back for another opportunity and then been stopped out again. So this movement here was an induction to trigger people to either get into sells, trigger their sell stops to in the opposite direction, and then they drove the price in the opposite direction. Now, the injection of liquidity here that came from the news is the small amount. The major amount of liquidity that's going to come into the market is what I'm going to show you now. So onto the analysis. Now you understand this picture here. What are we looking at when it comes to the dollar index? So right now, I'm going to put this here, put this on standard. Let's go to the 30-minute time frame. So this is our area of induction that we're looking at over here. All right. The price has broken market structure here. Now, if you remember in the Discord group and also in a LinkedIn group and all the other channels that I post in and on YouTube, I told you that this liquidity gap that was left here came from the CPI news on Tuesday, and it will be filled out. And this is another obvious reason why the price would have to go long, because this gap won't last forever. Now, on the H1, you can't see it, but the 30-minute and below you can do. Now, based on the structure that I've given you in terms of market harmonics, which the price will still have to follow, this is our A point right here. Here's A. All right, here's our B point over here. And then we have our C point, which is coming up over here. Now, the C point, what the price is trying to do, as I said, I'll take it in deeper levels as to why the price has to pull back. I'll say in terms of difficulty to explain or to understand, level 2 would be that the price needs to pull back to find the demand liquidity. This demand zone is the area of liquidity that triggered the price to push this long. And so price will come back to this area to fill out orders. And that filling of orders will cause the price to go long. Now, what type of orders? It will be bullish orders. Okay. Now, with institutional money, they may be in at the bottom because of high-speed algorithms, or they're not in yet, and they'll drive the price one more time short. Now, why would they drive the price one more time short? Well, because there's a bearish bias in this market structure here on the H1, one of the smartest things to do would be to create a bearish bias and get people to sell again. Because now when the price starts to sell off, and probably even dramatically, that sell-off will trigger people to say, I'm going to get in for a sell. If I was to actually draw lines that look like a trend line over here, across here, or even up from the high here, a lot of people would say, looking at this, that the price has just touched another trend line. Okay, now if you understand institutional money, really this is a short, but for a triggered from a different reason. But you know, trend line traders, algorithms that follow trend lines, and even moving average indicators and stuff will be using the mathematics of this bearishness to take a sell, which they'll be correct about. And as soon as the price hits this area of demand, the price will start to shoot up very strongly long. But for others, they may stay into this trade and quickly realize that they've lost either some of their profit, all of their profit, or been stopped out, or even at break even stopped out. All right, so what we need, I'm going to delete this trend line to make some space. What we do need now is the final part of this market harmonics, which is going to be our C swing. Okay, so I'm going to put some markings here. So here's the C swing. This area here is the M30 demand zone. So I'm going to write that out. M30 demand zone. All right. What does that mean for us then? So what we need now in terms of what direction should we look for in terms of this week? I'm going to put this here, change this to black and make it a little bit smaller. I'll start with 8. So in the shorter term, which means the pullback, now the dollar index, we're using this to trade other things. We're not exactly trading the dollar index. If you want to trade it, you can, but we're using the dollar index to follow the price. Now, if you've never watched any of the videos, again, when the dollar index loses value or the price decreases in value, it means that the direction of major pairs will change also. How will it change? So let's look at this. Now, in the shorter term, we have one more pullback here. So the shorter term movement. So shorter term is right over here. Now with the shorter term movement over here, what does that mean? So it means that for X USD pairs, now X, I'll show you what X is in a moment. And I'm specifically focusing on major pairs because, guys, major pairs are the easiest to trade. And even as a professional trader, the more simplistic you can be with your pairs and with your trading, the more profit you're going to make. So whether you're a new trader or you've been a trader for 10, 20 years, it doesn't matter. Major pairs are very simply the best things to trade because they're the most liquid, the most active. The news reactions are pretty awesome on them. They work out the best and they're very simple to follow. And there's things like the dollar index that you can add as a strong piece of extra evidence to your trading hypothesis when you create them or your trading analysis. So back to this. So XUSD pairs where X is the base currency in the shorter term would be right now bullish. Okay. They would be bullish, which means they will buy up or go long. Okay. Let's change this to purple again. All right. On the other side of the story where the US dollar is the base currency, all right, so like this, it will be bearish in the short term because as the dollar loses strength, it means the US dollar itself will be weaker against other currencies. And this can be commodities too, like gold and silver, but I haven't really seen a USD gold. It's usually gold to the US dollar. All right, so we'll put here sell. So in the shorter term, this is what we should be looking for in terms of our trades that we're looking at. And then just to put this here, this means, and I'm just going to use some shorthand here, negative dollar strength. Okay, so in the shorter term, we're going to have bearish dollar strength or negative dollar strength. And then on the other side of the story, so I'll make this red so that it's color coded for your eyes. All right. And then on the other side of the story, we're going to have bullish dollar strength, so positive strength. Let's make that green. Here you go. Now the roles will be reversed. So for the longer term movement that we're looking for, which I've discussed, and I won't go through the longer term here. If you want to watch the longer term, please watch the previous video, which is episode 4 of my series called the Game Plan. So the longer term over here, let's write that out. The longer term will be the opposite. So for USDX pairs, I'll start from that. We would be bullish. Here you go. So bullish, so buy over here. And then for XUSD pairs will be the opposite. So we have a long-term bearish sentiment, which is so bearish, which is a sell. Okay. So as soon as the price gets here, the moment the price gets here, all right, so I'm going to put, okay, when C forms. So when C forms. So when the C forms, which is this point right here, and the price returns to demand, this is when this aspect of the market will trigger. For now, we're in this phase, the shorter term. And of course, the price will do as many things as it can to stay around here before it pulls back here. All right. Now, another reason, again, layer 3 as to why the price will have to pull back here is because this range right here is a liquidity void. The price has injected money into the market without balancing the order book. So the order books are imbalanced on the market here. So this is the higher complex level as to why the price will need to pull back here. All right. We could go further and deeper, which will require me to go on lower time frames, but I don't want to overcomplicate it. The foundational thing that we're looking at here is direction. So we'll stick to that. So what we need is in the shorter term, a pullback here. Now, what does X mean? And then we know what we're looking for in the shorter term. So X, specifically, we're looking at major pairs would be Swiss franc, Australian dollar, New Zealand dollar. It will be the pound. Okay, it could be the Japanese yen as well. And it could be the Canadian dollar. I believe I've covered all of them. Okay. Now, if you're not too sure what major pairs are, on most brokers, they've made it pretty easy. And of course, there are debatable, you know, amounts of major pairs. Some say there are 8, some say there are 7, some say there are 5, some say there are 4. But for Hugo's Way here, they're usually highlighted in a separate color so you know what they are. So that's AUD USD, Euro USD, Pound USD, NZD USD, USD CAD, USD CHF, USD JPY. Now, some others say that the pound Euro GBP, so I always say it wrong, the Euro versus the pound Euro GBP can be added to that list. Personally, for me, I would say no, but for me, I like to stick to major pairs that are paired to the dollar specifically. So Euro USD, Euro USD CAD and etc. X also, I put a comment here, can be commodity. So it can be gold, could be silver. Now gold is XAU, silver is XAG. Okay, and you can have a look. There's platinum, which is a XPD, I think, or something like that's palladium. XPT is platinum. Okay, it can be oil. Okay, and it can even be crypto, so it could be Bitcoin, Ethereum. Okay, now usually with the commodity and the cryptos, it's not usually the US dollar first and then the asset after. It's usually the asset compared to the dollar price. That's usually what it is, which makes sense because we want to focus on the asset, not necessarily the dollar. Okay, so bearing this in mind, what does that actually mean for you right now? So if we do a recap on the analysis that we have now, starting with USD CHF on the weekly, the prices come to this very key area, which is the full depth of demand after this induction that we've had from 2021, okay, which is absolutely brilliant. Now, in the shorter term, what we do need is the price to be bearish. So if I took USD CHF and I pull this back here, I have another set of markings here. USD CHF, which looks very similar to the dollar index, if I say so myself, the price has taken the high of the previous day and it's come back to this area of supply right now. And what we really need with USD CHF is for it to pull back here. Now, it could take the low of the previous week, okay? And I'll say the way to map this the easiest, I'm going to mess up my charts for a moment, is the moment the dollar index gets back to this demand area, so 100,581.581, the moment it gets there, that's the moment you'd want to enter USD CHF long. But if you're not looking at the dollar index, then the expectation for me would be for the dollar index to arrive anywhere from this demand zone here to the low of last week. That range here, which is around about 15 pips in range, would be my entry to go for the long. Okay. On the other side of the story, we have Pound USD, our second trade. And Pound USD was important. Why? Because as I explained, this supply liquidity here, which produced the short that we had, which created a new all-time low, historical low at 1.03, the previous one being 1985. On the pullback over here, we had unfulfilled efficiency. Last year, 2022, price attempted to get into this area and it couldn't. At the beginning of this year, 2023, price tried to return to the zone and it didn't. Now, both of them did have quite strong shorts, this short being the longest, around almost 700 pips. However, the price couldn't sustain the short. There wasn't enough supply liquidity to do so because it didn't return to this area of supply, which is the key area that is controlling supply liquidity. Now, as I told you guys, and I called it before it happened, the moment the price got into this area, now we were starting to dip into areas of liquidity that we can actually look for a massive short, at least back down to 1.1 on Pound USD. Now, since the price has taken the high, we've had this induction of the previous weekly high, which is what I was looking for. On Friday, you can see as soon as the price got above the high, we had a strong short, okay? Now, with this strong short, what are we looking for? So, because we need, and again, just to reference this, I'll bring back up my 30-minute movement here. If I drag this all the way to the top here so we can use it as a reference, currently we need the dollar index to pull back down to this area, which means a negative dollar or bearish dollar. If the dollar is bearish, it means that XUSD pairs will be bullish, which is what we need. We actually need the price to come back here at least, and then we can look for our sell entries. So anywhere from 1.25, 102 to 1.25, 214 is good enough. Stop loss above the high, and we ride the wave short. Okay, so that's number 2. Number 3 was AUD USD, which again, similar situation. The price took the weekly high, gave us a massive strong short. All we need now is the price to find supply one more time on the upside, and then we go for a short. Okay, now my markings have shifted a bit, but you can see this is what I'm looking for. Something of this sort. And as soon as the price gets here, just as we're looking, as soon as the moment the price gets in here, that will be the moment we're looking for that longer term swing. So all of the buys that if you wanted to take a buy this week, will become sells as soon as we get here. So the entry for the sell would be your take profit for the buy. So as soon as the price gets here, you're closing the buy and you're putting on a sell. Okay. Now, with all of these trades that we're looking at, they're all high probability. We're not going to go and trade all of them, but at least having at least two. For me, what I usually like to do is, if I'm trading a USD X pair, so in this case, USD CHF long, I like to have an opposite pair like pound USD short. I don't like to usually do like a USD CHF long, USD CAD long. I like that correlation. I think it helps mentally because you can see the dollar's movement. It's easy to track and trace because if the dollar changes direction, you can follow it on both pairs easily. And just mentally, it's just nice to see that when one is going one way, the other is going in the opposite, that correlation way. So it's kind of like, you know, you're really in there, you're in your game, and, you know, you'll be in your bag as well. So finally here with gold, again, gold on the H4, we still have this buy order aggregate that we haven't forgotten about. But the great thing with gold, and I did promise on the video that I did previously, episode 4, that I would go through entries that we can possibly have. So as promised, I'm going to do that. So on the H4, price has entered into the supply flip zone over here. It's taken the previous week's high in a very dramatic way. And I believe the simplest entry, I'm going to go through this here to put a foundation here, is in terms of entry, I'm not expecting the price to go and take the highs of the previous week up here. It could do, but I'm not looking for that. But what I do expect the price to do is I'm looking over here. Now I'm going to use this purple color here to show you. So the previous demand zone, the last demand zone for the day before this massive drop, which is Thursday, price pushed long, but wasn't able to take this high. And then we had a close beneath here. And when the price returned, we have what we call a nested supply zone on the H1 here. So this nested supply zone became the key pivot zone for us to be able to have supply liquidity in the market. So for me, my gold entry, if you're looking for gold entries, and I know some of you have asked me, I'm looking for the price to actually return just here. As a first attempt, and I'm going to put first attempt here, first attempt will be an entry right here. First attempt. First attempt will be an entry right here, and I'll use blue again to show what I'm talking about. Here would be my first attempt. Stop loss will be above, I would say, this wick here, because this is the last induction, so stop loss will be here. All right, I'll say for attempt 1. All right, this will be my first typical entry I'll go for. The second trade is the price returning up to this range here. So my stop loss will be for attempt number 2 at this swing high here. Okay, I get the sense that the price has done enough weekly movements to, and I'll probably change this to another color just to differentiate them. So I'll go for like a sky blue. And my entry would be here for first attempt entry. Okay, attempt number 2 would be here. So for attempt number 2, guys, this would be really what I'm looking for. If I extend this zone and maybe change the color so that there could be a little bit of a differentiation here. Let's try, not coral. Let's try the thistle, pink or something. Okay, here. This will be my second entry here as an attempt for a short. These are the 2 areas that I would go for. Now, of course, if the price takes the high of the previous week, which is up here, then yes, of course, all right, high of last week, then yeah, I'll look for a trade as soon as the price takes the high. That's another option. Let's put that in black. But nonetheless, I think for me, guys, these are the 2 entries that I'm going for. And I believe that with gold, these entries are more than enough to get this major sell that we're looking for. So in the short term, it will be a buy. So a negative dollar would mean a bullish XAU USD one more time. And then after, when the price gets to that C swing point again, over down here, then we know that, okay, we're going to go for our major movement. So this is gold, which was one of the pairs in the high probability action that we have. So USD CHF is number 1, pound USD is number 2, ADUSD is number 3. And as again, if you watch the video carefully, you can go for the alternative of NZDUSD also, which again, I told you, looking back at the price action, I kept the chart. The 2008 market crash that we have has been operating in unfulfilled efficiency for 14 years. And the price didn't return to this demand zone, if you look at it carefully, inside of this demand liquidity to go for a long. And I do believe it was left on purpose, but now we're in another stage where we have inflation as a problem, and the perfect kind of cocktail of market scenarios that can push the price down to this area of 48. So you can also look for a sell here. But I'm sticking to ADUSD because it just moves a lot better for me personally. But if you want to go for NZDUSD, you can. And of course, finally go. All right, now this video is not a technical news video. If you want to go through the news, I've done the news overlook for the last 2 or 3 weeks, so you can have a look at that. But I wanted to keep this video as short as possible, okay? And I hope you guys enjoy this. Make sure you leave some comments if you want to get these markings that you can look at, you know, on your own computer, written out for you. Join our Discord group and our LinkedIn group. Make sure you like and subscribe. I appreciate the love on the last video. I see that there's a lot more views. I can see some thumbs up. I really appreciate you guys interacting with me, and I'm making sure that I'll deliver the best content that, you know, can be beneficial for everyone. All right, so I'll catch you guys later on. Thank you again for all the support, and I'll see you in the next video. Everybody take care and have a great day.